The most dangerous moment in trading may not come after a loss. It may come after too many wins, when confidence quietly begins to overpower caution. Repeated success changes how risk feels. What once seemed dangerous now begins to look easy, and that is where overconfidence starts. Confidence is essential in trading. But without discipline, confidence quietly becomes overconfidence, and that's where even great traders begin to lose. One victory becomes 2, then 5. Confidence quietly grows until the trader begins believing the winning streak will never end. He no longer feels like an ordinary trader. He begins believing he's smarter than the market itself, and that's often where every winning streak starts to fall apart. Some victories come from skill, others come from favorable market conditions that may never repeat. Mistake one for the other, and overconfidence quietly takes control. Probability has not disappeared, but overconfidence convinces him that the rules of uncertainty no longer apply to him. Analysis becomes shorter. Because success has convinced him careful preparation is no longer necessary, confidence quietly replaces discipline, and the first mistake has already begun. He stops waiting for confirmation, believing his instincts are now more reliable than his rules. In trading, that's often the moment confidence becomes overconfidence. The market rewards another mistake, and the illusion grows stronger. Confidence turns into overconfidence, while discipline quietly slips away. Position sizes begin growing, not because the setup improved, but because his ego did. Confidence replaces caution, and discipline quietly starts to disappear. The actual risk is larger, but overconfidence makes it feel smaller. That's how disciplined traders quietly become reckless, long before they realize they're in danger. He begins believing he can manage the trade manually because losing now feels almost impossible. But the market doesn't reward confidence, it rewards discipline. Every opposing candle feels temporary. He no longer reacts to the market, he expects it to prove him right. That's when confidence quietly becomes dangerous. Warnings are dismissed, because overconfidence mistakes caution for weakness. The market doesn't reward confidence alone, it rewards discipline. One broken rule becomes another, until the trading plan is no longer a rule book, only something he follows when it's convenient. And that's when discipline quietly begins to disappear.
NFP numbers are way off. It's tanking fast. Pips dropping like a rock. This is bad. Cut the losses now.
Then the first significant loss arrives. But instead of recognizing the warning, overconfidence dismisses it as temporary bad luck. Instead of reducing risk, he increases it, determined to prove the loss meant nothing. But pride never protects a trader. Discipline does. The conditions that created the winning streak begin to change. But the trader doesn't. Yesterday's confidence becomes today's weakness, and the market notices first. The same decisions that once delivered profit can suddenly create losses, because no trading strategy wins in every market environment. The professionals adapt while the overconfident pay the price. The losses begin stacking. Yet the trader still believes recovery is only one trade away. That single belief often becomes the most expensive decision of all. Reviewing the evidence would damage his confidence. So the ego chooses denial instead, protecting pride while quietly destroying the account. He doubles the risk, believing one trade will fix everything. Confidence gives way to reckless desperation, and discipline quietly disappears. One oversized position now carries weeks of hard-earned progress, yet the market remains completely uncertain. Confidence changes nothing, risk still demands respect. Without warning, the market reverses. And in a single moment, the confidence that made him feel invincible becomes fear. Closing the trade would mean admitting he was wrong. So pride keeps the position open, allowing a manageable loss to grow into something far more dangerous. The platform warns him before the damage becomes permanent. But ego refuses to listen. In trading, the loudest voice is often the one that costs you everything. The position is finally closed by force, wiping out the profits that built his confidence. In the end, it wasn't the market that defeated him. It was his overconfidence. The winning streak is now only a memory, and the trader is left facing the true cost of overconfidence. The market never rewards ego, only discipline. Professional growth begins with honest review, not by protecting the ego, but by studying the evidence. Every trade is a lesson if you're willing to learn. Risk returns to a fixed level because no winning streak can guarantee the next outcome. Discipline protects what confidence alone cannot. Every setup must earn the right to be traded. Regardless of what happened yesterday, professional traders trust their rules, not yesterday's victories. The professional trader enters with confidence, but never without respect for uncertainty. True consistency begins where confidence ends and discipline takes over. True confidence is quiet. It follows the plan, respects risk, and never needs to prove itself to the market. Discipline, not ego, is what keeps professionals profitable. Overconfidence begins when success is mistaken for certainty. The strongest traders stay humble because every new trade can still lose. Discipline, not confidence, is the real edge.